This is the Catch Up Network.
Did you know that simply buying and holding short-dated options in 2022 could have turned a tidy profit, while in 2023, sellers saw the gains? Discover why these contrasting market behaviors reveal important insights into option pricing and volatility dynamics.
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Dr. Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, for an update on short-dated options and the difference between 2022 and 2023 price behavior. Russell, it's great to see you as always. Welcome back to Trade Talks, and you've been focused on short-dated index option pricing. Give us an update on what's happening with that.
Sure. So, starting in 2022, as the different expirations were being rolled out, we paid very close attention to the one-day straddle pricing on the close that expired the following day, and just to see, how well these options were being priced. And in 2022, what I'm getting ready to say is totally opposite of what anybody thinks with respect to options. But in 2022, if you just consistently bought an at-the-money straddle the day before it expired and held it into expiration, you'd have made nothing short of a fortune, which means these options were continuously being underpriced relative to the subsequent day's move. Now, 2022 was a more volatile year than 2023, but the premiums for those options were also much higher than they have been in 2023. And in 2023, option sellers would have made out quite well. So it's quite a contrast between 2022 and 2023.
Exactly how did you determine these options were underpriced?
Sure. So what we would do is for every day where there was a PM settlement in 2022, and as I mentioned, they got rolled out over the course of 2022. So like we did not have Thursday expirations until August of 2022. So not as many observations on that day, but we would take the midpoint of the bid-ask spread on the close the day before expiration, and then account a bit for commissions and slippage, and make an assumption that selling a straddle or buying a straddle would be held into the cash settlement the following day. The fact that I think 8 out of 12 months selling a straddle would have resulted in losing money in 2022, and the cumulative P&L over the year in 2022 for a straddle seller was, I think, down about 6,000 points, and that number's coming off the top of my head, but that's pretty substantial when you add the $100 multiplier and then maybe trading more than one contract. In 2023, straddle sellers have had a small profit. It's about $200 or $300. About 200 or 300 points through this year. And straddle buyers have lost a little bit. And that's the kind of pricing that you would expect. So it's pretty obvious that as they were new in 2022, the liquidity providers were maybe having a hard time figuring out how they should go about pricing these options.
Why do you think there's such a difference between 2022 and 2023 price behavior? Is it based on the volatility you were talking about?
I think it's a combination of a couple of things. I think 2022 was a much more volatile year than 2023. But on average, the at-the-money straddle in 2022 was priced at 1.5% of the index each day. The average in 2023 has been only 1%. So the options had elevated pricing last year, but not enough to account for the average move of about 1.6%. So it's just a matter of not pricing the options correctly based on the volatility environment. Typically in higher volatility environments, the market makers do a pretty good job of pricing the options, but maybe just because they were relatively new last year, it took a while for them to get a feel as to how they were going to trade.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
The year 2022 marked a notable phase in the development of short-dated index options, characterized by an extraordinary level of market volatility. This volatility, along with the relatively nascent state of these financial instruments, led to their consistent underpricing. An at-the-money straddle bought in 2022 would have yielded significant returns due to these mispricings. Conversely, as market makers refined their pricing models in 2023, options were more appropriately valued, leading to diminished returns for buyers and modest profits for sellers. The reduction in volatility and improved understanding by liquidity providers contributed to this shift, demonstrating the learning curve in options pricing within fluctuating market conditions. The data highlight the complex interplay between market volatility, pricing strategies, and the maturity of financial products.
Thanks for watching, and of course, if you like this video, don't forget to like and subscribe below. But don't stop there. Start making videos like this for your own channel. Click the link in our bio to get started.
This is the Catch Up Network.